Ever stop and think about those companies that just seem, really set up for long-term growth, the kind where you invest, look away for a decade, and maybe, just maybe, find a nice surprise?
Definitely. And that's what we're digging into today. We've got three specific stocks that the Motley Fool flagged as potential buy-and-hold winners for the next 10 years.
Exactly. So for this deep dive, we're looking at their analysis from an article they published back on April 28th, 2025.
Right. And our mission really is to get under the hood, understand why these three Dutch pros, Axon Enterprise and MercadoLibre, why they stand out according to the Fool. What are the key drivers? What's the potential upside they see?
Okay, let's kick things off with some energy, maybe some coffee talk. Dutch Bros, symbol BROS. Most people probably know them, that rapidly expanding coffee chain.
Yeah, they're becoming much more visible. But the really eye-catching thing from the Fool's perspective is this long-term vision they have.
Which is massive, right? Going from about 1,000 stores now to potentially 7,000.
Exactly, 7,000 locations. That's a huge runway for growth they're mapping out. It signals a deep belief in their brand and model.
And the article stresses this isn't an overnight thing. It fits that buy and hold idea perfectly. You're looking potentially years out.
Absolutely. It's a long game. And they seem to have struck a chord with customers. The Fool mentions their sort of down-to-earth brand identity, some unique drinks, and keeping prices reasonable.
Plus the convenience factor. They really leaned into the drive-thru model early on, which is, well, super convenient for a lot of people.
For sure. But they're not just sticking to that. They're also branching out, thinking about what the article calls omni-channel options. More tech, faster service, adapting.
So it sounds like they're trying to hit multiple angles, drive-thru convenience, plus newer ways to order and connect.
Yeah, seems that way. And investors seem to be buying into it. The Fool notes positive sentiment, a belief that this expansion can actually happen.
It's interesting. They also point out that even if Dutch Bros hits 7,000 stores,
It'd still be smaller than Starbucks.
right, which kind of hints that maybe even 7,000 isn't the absolute ceiling way down the line.
Potentially. It suggests the market itself is huge. Now, looking at the performance, the article pulled some numbers from Q4 2024.
Yeah, let's look at those. Revenue was up, 35% year over year, hit $343 million.
Pretty strong growth, and same-store sales are up too, nearly 7%.
Which is always a good sign. Means existing stores are doing better, not just growth from new openings. And transactions were up slightly as well.
And profitability looked better too. That company-operated shop contribution margin, it expanded by about 2.4 percentage points, up to nearly 29%.
That's a healthy margin. And they actually turned a profit, right? Went from a loss the year before to $6.4 million in net income for the quarter.
Correct. So you see revenue growth, same-store sales growth, better margins, and a flip to profitability. All, generally positive trends.
Okay, but here's the catch the Fool mentions. The stock itself, it's not exactly cheap right now.
No, definitely not. Trading at a forward PE ratio of 74. Well, that's pricing in a lot of future success.
Right. So for anyone listening, that PE ratio basically shows how much investors are paying now for each dollar of expected future earnings. 74 is high.
It signals very high expectations. The market is betting heavily that Dutch Bros executes on that massive expansion and grows earnings significantly to justify that price.
So the argument, according to the Fool, is basically, yes, it's expensive now, but the sheer scale of the growth potential, combined with the brand strength and those positive financial trends, it could reward patient, long-term holders.
That seems to be the core thesis. It's a bet on that long-term expansion story playing out successfully.
Okay, let's shift gears. A completely different sector now. Axon Enterprise, symbol Axon.
Right. The Motley Fool positions them as really a dominant player in law enforcement tech over the last decade, and they expect that to continue.
Most people probably know them for their tasers, the electrical weapons.
And body cameras. Those are sort of the cornerstone products historically.
But the Fool highlights how they've evolved way beyond just those devices.
Exactly. It's become much more of a network, a whole suite of products, including a lot of software now for managing records, evidence, investigations. It all links together.
Creates stickiness, I imagine, once a department uses their whole system.
It's harder to switch away, yeah.
Yeah.
And they're innovating, too. The article specifically calls out their work in AI.
Ah, yes. Draft 1. That sounded pretty interesting. Using generative AI to write draft police reports from camera footage.
Yeah, apparently it's proving popular. Think about the time savings for officers if it works well. Drafting reports is a huge time sink.
Huge. So this AI integration, it's a key part of their future growth story then.
It seems to be. It shows they're not just resting on their hardware laurels. The Fool points to a few key advantages for Axon going forward.
Okay, like what?
Well, first, just their clear industry leadership gives them a strong base to scale from, deepen relationships, and sell new products like Draft One into their existing customer base.
Makes sense. Leverage that position.
Second, their growth track record. They've apparently grown revenue pretty consistently, like 20% or more annually for the last 10 years. That's impressive consistency.
Wow. Okay. Decade of strong growth. What else?
They're also expanding beyond law enforcement into the private sector.
Oh, interesting. How so?
The article mentioned a big contract, possibly with someone like FedEx or UPS, wasn't named explicitly, but a major logistics firm.
To put body cameras on delivery drivers.
Exactly.
Yeah.
Think about accountability, safety, disputes. It opens up a whole new potential market for their tech.
That could be massive. Okay, so leadership, consistent growth, AI innovation, new markets. Anything else?
One more point the Fool raised, which is pretty relevant maybe now, is resilience.
Resilience to what? Economic downturns?
Yeah, things like tariffs or even a potential recession. The idea is their main customers are government, state, local, which tend to have more stable budgets than, say, consumers.
Okay, government spending is often less volatile.
Right. Plus, their technology, like that Draft One AI, could actually save agencies money or make them more efficient. So the spending might be seen as justified even in tighter times.
Got it. So less likely to get slash from budgets, potentially.
That seems to be the thinking. So putting it all together, the argument for Axon is market leader, strong, consistent growth history, innovating with AI, expanding into new private sector markets, and potentially quite resilient economically.
It does sound like a solid case they're building there. Lots of different growth levers.
Yeah, it appears quite multifaceted. Strong position, clear strategy.
All right, let's travel south now for our third one. Latin America. MercadoLibre. MELI.
Ah, MELI. Yes. The Fool identifies them as basically the dominant force in e-commerce and fintech across Latin America.
And they really emphasize the growth potential in Latin America, right?
Yeah.
Especially for digital services.
Absolutely. They cite an e-marketer stat that something like 35% of adults there didn't even have a bank account in 2023.
35%. Wow. That's a huge chunk of the population that's, well, underserved by traditional banking.
Exactly. And that creates this massive opportunity for digital payments, online shopping, fintech solutions, areas where MercadoLibre is already the leader.
And the stock's performance certainly reflects some of that. The Fool notes it's up, 1,400% over the last decade?
Incredible run.
Yeah.
And yet the argument is there's still plenty of room to grow. This company's been around over 25 years.
And still posting high double-digit revenue growth.
Yeah, 37% jump year over year in Q4 2024. And they're apparently gaining market share in their biggest markets, Brazil, Mexico, Argentina.
So what exactly do they offer? It's more than just an online store, right?
Oh, yeah. It started with the marketplace, which is huge, 67 million active buyers mentioned. But the financial services side, Mercado Pago, is enormous too. Mobile payments, credit cards, lending.
Kind of like an Amazon and a PayPal combined almost.
That's a pretty good analogy, yeah, for the Latin American context. And the scale is impressive. The Fool mentioned $21 billion in revenue in 2024 and generating $1 billion in free cash flow.
That's serious money. $1 billion in free cash flow gives them a lot of flexibility.
It does. And interestingly, the article suggests they could probably squeeze out even higher profit margins and more free cash flow right now if they wanted to.
But they're choosing not to. Why?
They're strategically reinvesting that cash back into growth. Things like expanding their credit card business, building more fulfillment centers to make shipping faster.
So playing the long game, sacrificing some profit now to build a bigger, stronger business for the future?
Precisely. These investments might pressure margins a bit in the near term, but the idea is they'll lock in market share and drive much bigger profits down the road. It's a common strategy for high-growth leaders.
Okay, that makes sense. What about valuation for MELI? Is it also sky high, like Dutch Bros?
Well, it's not cheap. But the Fool points out something interesting. It's price to sales multiple. Comparing the stock price to the company's revenue.
Yeah.
It's actually trading towards the lower end of its own historical range from the past decade. It's been much higher before. At the time the article was written, it was around 5.3 times trailing revenue.
So while the company is firing on all cylinders growth-wise, the stock's valuation relative to its sales isn't as stretched as it has been sometimes in the past.
Correct. That historical context suggests the current valuation might actually be relatively attractive, especially given the huge growth runway ahead in Latin America.
Okay, so the core argument for MercadoLibre is massive untapped market in LATAM, clear leadership in both e-commerce and fintech, strong revenue and cash flow, reinvesting smartly for the future, and maybe a valuation that's not overly demanding compared to its own history.
That sums it up nicely. You've got strong secular trends like digital adoption, a dominant market position, and strategic investments all working in their favor, potentially.
Right. So there we have them. Three very different companies highlighted by the Motley Fool. Dutch Bros, banking on aggressive coffee shop expansion.
Axon Enterprise, leading in law enforcement tech and pushing into AI and new private markets.
And MercadoLibre, riding that huge e-commerce and fintech wave in Latin America. All positioned, according to the Fool, as potential long-term holds.
And it really makes you think, doesn't it? Three distinct stories. Which one, resonates most with your own view of the future, your own tolerance for risk, your investment timeline?
That's a really good point. They're definitely not all the same type of bet. Which brings us to maybe a final thought for you listening.
Yeah.
Given these different stages of growth, Dutch Bros expanding physically, Axon leveraging tech dominance, MercadoLibre capturing a developing digital market, how might these specific picks reflect broader shifts, in how we'll shop, how technology shapes public and private sectors, and just global economic development over the next decade?
Yeah, that's interesting. How do these specific company stories maybe tell a bigger story about the next 10 years? Definitely something to chew on.